welcome back. Today what I'd like to do is talk about delta hedging an option. If you haven't seen my previous video on the Black-Scholes model where I actually derive the partial differential equation, that is the Black-Scholes equation, the argument itself for that equation is based on a continuous time delta hedge. In this video what we're going to do is we're going to take a look at the delta hedging strategy itself, and hopefully by the end of the video you'll have a better idea of what a delta hedge actually is and the intuition behind the price that gets generated from the Black-Scholes model. Now, regardless of if you understand the derivation itself of the Black-Scholes equation and solution which yields the Black-Scholes model, this right here is going to give you the price of a European call according to their assumptions and arguments, that is, of the Black-Scholes model. I've implemented this equation in Python to generate prices based on a specific parameter set, and I've also created this nice chart to help us visualize the price of an option based on the underlying asset price and the corresponding delta of the option. Now, what is delta? Delta is the first order sensitivity of the option's price with respect to the underlying asset's price. Now, in layman's terms, what does this mean? This means as the underlying asset or the stock that our option contract is written with respect to changes, we can expect a subsequent change in the option price of approximately delta. It is a linear approximation of the change in an option's price based on a unit change in the underlying asset price. Long story short, it is how we can expect the option's price to change when the stock price changes. This red line here represents delta itself, and it's also sometimes used as an approximation for the probability that an option expires in the money. So you can read into delta in a variety of different ways, and you can see that as we change some of the parameters, the pricing function for the option along with the delta function changes. So as our time to maturity increases, you can see the subsequent change in the option pricing function and the delta function with respect to, of course, the underlying asset price. If we narrow this time window, this starts to look like a classic hockey stick diagram, and we get this almost sigmoid looking function situation for our delta. That is, there are more significant changes when we have fluctuation around the strike price when we are very close to expiration. And this is relatively intuitive because you will see that if you are hovering around the strike price at expiration, then there is going to be a lot of variation in the option price depending on whether or not it is changing towards in the money or towards out of the money status. Let's look at a quick example of the two interpretations of delta. So suppose I have this option contract, and this option contract currently has an underlying asset price of $100. That means I will pay roughly $10 for this option. The delta of this option, according to these parameters, if we go up to this red line, is roughly 60%, 0.6. What this means is if the underlying asset price was to move from 100 to 101, we would expect a option price change of 0.6. In other words, we would expect the option price to increase by approximately 0.6. Moreover, the other interpretation is that the option has roughly a 60% chance of expiring in the money. This model, of course, assumes that the dynamics of the stock follow a geometric Brownian motion that is characterized by this stochastic differential equation. And this stochastic differential equation is parameterized by a volatility term, by a drift term, and a Wiener process, that is the Brownian motion itself. I have written a function here to simulate a geometric Brownian motion. In my Python library QFin, I also have this capability, so you can just import the process itself and simulate it if you would like to do it that way. And every time we run this, we will get a different path according to that process, according to the process that is assumed by a Black-Scholes model. Let's pause right here and talk about delta hedging. The argument for the Black-Scholes equation revolves around a continuous time delta hedge. That is, if we hold a portfolio of stock and option, and we hold a particular quantity of stock, we can ensure that a instantaneous change in our portfolio value is essentially risk neutral. That is, we remove the randomness from our portfolio. In turn, we must earn a risk-free rate, and that establishes the Black-Scholes equation, whose solution yields the Black-Scholes model. Now, that delta hedge is clearly impossible to do because we can't continuously hedge a portfolio. We would accumulate way too many transaction costs. We can, dive into all of the assumptions that are violated by the model, but if you have a model that doesn't make any assumptions and you have the true density, then we wouldn't need to develop a model in the first place. If you had the true density function for the price of all options, I would ask you, what are you doing here? You should be making money with that true density that you have access to. Nevertheless, this delta hedging argument is what allows us to establish the Black-Scholes model price. What we're going to do is we're going to conduct a delta hedge, but not in continuous time. We're going to conduct it on a daily basis. So what's going to happen is we are going to sell an option, and then we are going to delta hedge that position, which means we're going to buy stock to ensure that our portfolio is delta neutral. We have that risk neutral portfolio. In other words, an instantaneous change in our portfolio value is not going to yield a change in our portfolio value. Therefore, we must earn the risk-free rate. What we will see is throughout the life of this delta hedge, we are going to accumulate P&L. Now, we could accumulate P&L in a positive sense. We could accumulate P&L in a negative sense. We could end up making money. We could end up losing money. But the amazing thing about the numerical argument, which we are about to conduct for a delta hedge, is as you approach continuous time hedging, that is, as you approach this idea of continuously hedging your portfolio, which is of course only theoretical. Before I get 1,000 comments about transaction costs, I know there are transaction costs. I trade myself. I understand how this works. The theory itself suggests that as we approach the continuous time, we will approach the expected value of the option, which is the Black-Scholes model price. In other words, if we do a continuous time delta hedge, on average, if we take a look at P&L, we should see that we get approximately the Black-Scholes model price. And that is the incredible thing about this numerical argument that we're about to take a look at. And then the subsequent idea of taking a position based on violations of these assumptions is how we can in turn make some money. So let's take a look at these different arguments here. Let's take a look at delta hedging in the context of a short European call position. I'm going to sell a European call option, which means my net delta position is going to be negative. In other words, if the option price increases, this is good for the guy who holds the option. He wants the option price to go up. I don't necessarily want the option price to go up. If it does go up, that means the value of my option is going to decrease. Now, what can I do if I know that if the option was to go down in value when there's an increase in the underlying price? Well, I can go ahead and buy stock. If I buy stock, then if the underlying asset increases, I'll make money on my stock, even though I lose money on my option. So, how much stock should I buy? Well, I'm going to buy delta shares of stock. This is going to ensure that they perfectly offset. So if I buy delta shares of stock, my option price is going to go down by delta, my stock price will go up by delta, and vice versa. Now, of course, we see that delta and the option price are nonlinear functions, which means our linear approximation is going to get worse and worse as we move away from our initial point in which we are hedging about. Therefore, we must continue to rebalance the hedge throughout the life of the option. This is the continuous time or the continuous hedging argument made for the Black-Scholes equation, which we cannot do, so we will do it on a daily basis. Then what we will do is we will calculate the P&L from our stock position and then take a look at the ending P&L in a variety of different situations. So I have this function to simulate a delta hedge. I'm going to run it. I'm going to run it under this parameter set here. So I have a spot price of 100, strike of 100, time to maturity of a year, 5% risk-free rate, 20% vol, and then an 8% drift. Our option price is going to be 10.45. Our initial delta is roughly 64%. And here is one possible outcome. This is one possible outcome. Our final P&L from delta hedging is 44.05. If I was to run this again, this is going to be another one of 44.05, 44.03. Here we have accumulated negative P&L. We have negative 55.95. You get the gist. So every time we conduct a delta hedge, what we're doing is we are going to say, on this day today, let us purchase delta shares of stock. Tomorrow, I'm going to buy or sell stock to ensure that I hold delta shares on that day. And I'm going to continue to do that throughout the life of the option. And then at the end of the option's life, I'm going to accumulate a P&L from the stock and the option position, and that may be positive or negative. Okay, so knowing that each time we simulate a stock price path according to the geometric Brownian motion and conduct a delta hedge, we accumulate a P&L. What happens if we repeat the simulation a large number of times, say 10,000 times, and then take the average P&L? Well, it turns out, depending on how frequently we delta hedge, that is on a daily basis, twice a day, so on and so forth, we are going to get a price that closer and closer reflects that of the Black-Scholes model price. In other words, the model price is 10.45. If I was to repeat this daily delta hedge, in this case, I get a mean P&L of 5.72. If I was to increase the frequency of hedging, you can see that the mean P&L is going to start to approach that Black-Scholes option price. In other words, the expected P&L, should we be hedging in a continuous sense, is going to be the Black-Scholes model price in general. So we can expect to be just collecting the premium for the option price. We are not going to earn any excess P&L should we be selling that option short. In essence, this is connecting all the dots for it to be the risk neutral price. So how can we use this idea to actually trade? Well, we have to have an opinion on the parameter set that we're assuming to be constant. So in our current simulation, we have the spot price, the strike price, the time to maturity, the risk-free rate, and the volatility term. So if I had an opinion on volatility, let's say that right now NVIDIA is trading at 40% implied vol. And I think that the realized vol is going to be substantially less than the current market implied volatility, which is quite probable. There are papers on the idea of the volatility risk premium. I think AQR wrote one of the first on those. So clearly there's a way that we can capitalize on this idea to make money should we have an opinion that the volatility realized is going to be less. There's going to be some sort of theoretical, statistical, whatever you want to call it, edge. So how can we simulate to reflect this? Well, essentially what I'm going to do is I am going to fix the parameter set for the geometric Brownian motion under the condition of my opinion. In other words, I'm going to simulate the stock price with the idea that we are going to achieve a lower implied volatility, or I'm sorry, a lower realized volatility throughout the life of the option. However, I will price the Black-Scholes option with the current market implied volatility. So in other words, I'm going to collect a premium based on that 40% implied vol today, and then I'm going to realize stock price paths that actually follow something with less vol, maybe 10, 20% vol. And on average, what you'll see is there's going to be some sort of discrepancy that we can capitalize on to make money. So in other words, we should be seeing a theoretical price that is the expected P&L at the end of the simulations that is larger than the original option price that we collected a premium for. So let's go ahead and check this out. If I was to run this simulation here, $23.50, that seems like it's significantly more than what I had going on back over here. So in essence, what we're doing is we are selling a European call option for more than it's actually worth. And we are collecting a pretty penny based on the alternative. That is, we're realizing a price path or series of price paths that have the same parameter set as the Black-Scholes model, which was used to price the premium that we collected. In this case, we're saying, hey, those price paths are not going to be realized according to the parameter set that the model is pricing the options at. So in other words, we can collect more money right now than we should be allowed to do theoretically, because when the option expires, we are not going to realize as much volatility as the market thinks. And that is how you can capitalize on an opinion on volatility using the idea of delta hedging and the Black-Scholes model. So what's the big picture key takeaway of this video? It's that anytime that you think that the realization of a path or series of paths is going to have a different parameter set, that is, your opinion is the parameters should be higher, they should be lower, they will be higher, they will be lower, then according to this argument, you can capitalize on those opinions by conducting a hedge. That is, you can sell an option today for more than you think it's worth, or buy an option today for less than you think it's worth. And should you do this a large quantity of times over time, you will accumulate a positive expected value and P&L for your firm. I hope you enjoyed this video. Thank you so much for watching, and I will see you in the next one.